In this session, let's focus on risk aspect in capital budgeting. If you take any business, it has to operate in an environment where you don't get all the information. It means there are lack of information. You don't get all the information. So when you are facing lack of information, then sometimes you have to take a decision based on chance. What I'm trying to convey here is you don't have information on hand, then in such case you have to take a decision on a chance, and it's possible that the decision can go wrong. So when you take a decision where you don't have the exact information, there is a possibility that decision can turn out to be a favorable or unfavorable one. So when the decision turns out to be wrong on account of unfavorable end result, then we call it as risk. That is, the possibility that your decision can go wrong or the decision can lead to an unfavorable end result is called as risk. And what you have to understand is this risk cannot be eliminated. You cannot eliminate risk. So, as a chief financial officer or as a chief person associated with finance, your responsibility should be to minimize the risk. You cannot eliminate the risk, but you should take efforts to minimizing the risk. And the efforts which you take to minimize the risk is called risk analysis. The efforts which you take to minimize the risk is called as risk analysis. So I'm going to introduce these two technical terms to you. How do we take a decision to take up a project? Let's say you have a project and you have to take a decision, that is whether you should say yes to the project or you should say no to the project. This yes or no depends upon what is going to be the future cash flows, right? If future cash flows are very favorable, you would probably say yes, and if future cash flows are not favorable, you would say no. But again, this future cash flows are based on certain information which are currently available. But again, these information, it is not necessary that they should happen the same way. So the future by its definition is uncertain. Future by its definition is uncertain. So here understand, when you want to say yes or no to your project, it depends upon the future cash flows, but that future by itself is uncertain. It means in future this cash flows, the projected cash flows can be different. It can be different from what it was estimated or what it was expected. So there is an uncertainty with the future cash flows, right? There is an uncertainty, or I have written here already, there is an uncertainty with the future cash flows, and this uncertainty gives rise to what is known as risk. But understand, there is a difference between risk and uncertainty. Let me comprise once again. If you want to say yes or no to a project, it would depend on future cash flows. If future cash flows are positive, you would say yes, and if it is no, you would say no. But the future cash flows by itself is uncertain. Future cash flows by itself is uncertain. It means there is a possibility that future cash flows can be different from what it was expected. So this uncertainty actually paves way for risk, but there is a difference between risk and uncertainty. That is, risk is not equal to uncertainty. There is a difference. So let's understand what is risk first of all. So I'll put it like this. Risk is basically a situation where you will have several outcomes. In risk, you will have several outcomes, and you can have a possible range of outcomes, and within this range of outcomes, any outcome can occur. Any outcome can occur. Okay, and what happens is each outcome will have a known probability. Each outcome will have a known probability, and these probabilities are actually assessed by reference to the past information. Okay, so in risk, what happens is you are going to have several outcomes, or say a range of outcomes, and within this range any outcome can occur, and each possible outcome will have a known probability, and this probability is assessed by reference to the past information. So risk is basically an expression of possibility that actual will differ from expected. So risk is basically an expression that actual may not be equal to expected. So that's what risk is all about. That is, you are going to say that actual can be different from what was expected. So that's about risk. Then what is uncertainty? In case of uncertainty, you will not know what is going to be the range of outcome. You will not know what is going to be the range of outcome, or you will not know what is the probability. Okay, what is the probability of outcome, or you will not know both. You will neither know the outcome nor the probability. Okay. In case of risk, at least you will be able to estimate what could be the level of deviation from the actual, whereas in case of uncertainty, you have no idea or no clue what is going to be the outcome. So that's how the risk is different from uncertainty. In risk, there are going to be several outcomes, and any outcome can occur at the known probability, whereas in uncertainty, there is no idea about the outcome and you don't have any information about the probability, or you don't know about both. Okay, so that's how we understand the difference between the risk and uncertainty.